Okay, so let's begin here. So I introduced the bond supply and bond demand. The bond supply curve slopes upward. So the most important thing that I emphasize there is that, or in that video recording that I posted at Canvas already, there are three things that we always want to understand in the bond market. Maybe I just need to repeat this one again. That I wanna kind of like make you before we start going to talking about shifting the bond demand and bond supply curves. We need to understand how those variables get represented on this supply and demand curve. So let me open a slide here and oops, why did I close it? Share this. Okay, so one moment. So in chapter 4, we talked about the bond price and bond demand, and bond interest rates are jointly determined. You guys even saw it from the what? The formula for example, discount bond. So if anything about like say a discount bond, even coupon bond, the formula was very simple in chapter 4. We say the yield to maturity or interest rate on a discount bond, you take the face value minus price divided by price. Very simple formula. Okay, so that means given the bond face value and the price of the bond, you can figure out what the interest rate is. Or if I gave you the price rate, I'll give you the interest rate and I give you the bond face value, you can solve for the what? For the price. So bond price and bond interest rate are jointly determined. But of course, inversely correlated. So even though they're jointly determined, they move in opposite direction. In other words, if the bond price is increasing, that implies that the bond interest rate or the yield on the bond is what? Is falling. They always move in opposite direction. So now when we're trying to represent this in supply and demand, we have to be a little careful though, because typically when we're doing supply and demand, we're drawing it on a two-dimensional space. But when it comes to bonds, there are three variables that we want to represent. We want to represent the price of the bond on a graph. We want to represent the bond interest rate, and then we want to represent the bond quantity. So we want this P is price, I is going to be the yield on the bond or the interest rate, and then B is going to be the quantity. Okay, so in a two-dimensional space, if I have something like this, so I put price here and I put quantity here. Quantity will be represented by B. Okay, so we are going to, because there are three variables that I need to represent on this two-dimensional space, it's not possible to do that unless when I drew like a 3D diagram, like a X, Y, Z axis. But we don't need to do that, because I've already told you that the first two variables are jointly determined. Bond price and bond interest rate are determined together, but they move in opposite direction. We are going to read both price and interest rate on this axis. It's a little bit technical. So the idea is that if I draw, like say, the bond demand curve, which slopes downwards, okay, the key idea here is that if the price is this low, P1, that's going to correspond to this quantity demanded, you can say B1. But there's going to be a corresponding interest rate to this price P1. We can call it I1. This interest rate down here is very high, because we are saying that when price is down, interest rate is high. Bond price and bond interest rate move in opposite directions. So in other words, as I'm moving up this axis, the x-axis, bond price would be rising, but the bond interest rate actually would be falling. You get what I'm talking about, guys? Daniel, you see what I'm talking about here? Because I'm trying to read those two variables simultaneously on the vertical axis. So in other words, if the bond price increases from P1 to P2, That means there's a corresponding interest rate, I2, but this interest rate up here is actually lower than this interest rate down here because we're reading interest rate in opposite direction. So when the bond price is high, quantity demanded of bonds is low. And then the other thing that I emphasize in that was, so you're going to move from point A to point B. The other thing that I emphasize is that who are the demanders of bonds? Who represent the demand side of the bond market? The demand for bonds is represented by these are basically lenders of funds. Anytime you buy bond, government bond or state and local municipal bond, or you buy corporate bond, you are lending money to the corporation or to the government. So the demand, if you are buying bond, you are demanding bonds. So think about it. If you are the lender of funds, you are lending fund to the government. You want to get paid a higher interest rate, correct? Peyton, right? On your investment.
Right.
Okay, so that matches with this. So this from the law of demand. The law of demand says that when the price is low at P1, meaning that interest rate is high, because that corresponds to a high interest rate at I1. The bond demanders or lenders of funds they try to buy more bonds because that's when they make the most money. But when the price goes up from P1 to P2, first of all, it's too expensive to buy bonds. But interest rate is very low. So as a lender of funds, you don't want to lend money at a very low interest rate. So that means the quantity demanded is going to be low. So the law of demand says that at lower bond price, P1, that means higher interest rate, the quantity demanded of bond is higher. But at higher bond price, P2, that means lower bond interest rate, I2, the quantity demanded of bonds is lower. That's what I introduced. And then on the other side, I also introduced the supply side of the market. Okay. So let's talk about the supply of bonds. You're going to watch that in the video that I did yesterday, but I know I need to start from somewhere. So the supply side of the bond market, supply curve for bonds is upward sloping, just like you've seen any supply curve before. And again, we are going to be reading price and interest rate on this axis simultaneously. But remember, interest rates are read in opposite direction. So the bond supply curve is upward sloping. You can represent it like that. So when the price of the bond, okay, first of all, who represents the supply side of the bond market? The people who are supplying bonds could be government, suppliers bond are the issuers of bond. If you are supplying bond or you're issuing bond, you are the borrower of funds. That's right. So the supply of bond represents borrowing funds. When the US government issues treasury bonds, the US government is borrowing money from what? From us. And so the law of supply says that for bonds, if the price is low at P1, that means interest rate is what? Is very high. The quantity supplied of bond is going to be lower. That's right. Because nobody, whether government or corporation, want to supply a lot of bonds when interest rate is high. Because interest rate that corresponds to this P1 here is a high interest rate. So this is from a borrowing point of view. But when the price of the bond rises to P2, that means interest rate falls. Remember this I2 up here, we're reading interest rate in opposite direction. That I2 is actually less than this I1 down here. So that means when the interest rate is low and the price of bond is high, bond suppliers want to supply more. They want to issue more bonds. They want to borrow more funds because it's cheaper to borrow at low interest rate. So the quantity supply of bond is going to increase. So then the bond supply comes. So then what I did, I put everything, supply and demand, in an equilibrium, which is this graph here. Can you guys see this graph?
Yeah.
So see the bond supply curve is upward sloping, the bond demand curve is whatever. So this graph here I did not pick these numbers arbitrarily. This is actually a $1,000. This is a $1,000 discount. Oh, sorry, face values discount bond. And from chapter 4, you already know the formula for a discount bond. The interest rate, pen is acting up. What's going on here? The yield on a discount bond is given as face value minus price divided by price. So because the face value is $1,000, okay? So if the price of this bond is $950 up here, see this $950 up there? That's the price of the bond. If it's $950, we can figure out what the interest rate is. The interest rate is going to be 5.3% by using this formula. So you're just going to say, you plug in the numbers, I equals to face value is $1,000 minus the price here is $950 divided by the price $950. So if you use your calculator, you're going to find that this is going to be on top 1,000 minus 950, that's 50 divided by 950. So this is going to be equal to 0.053, which in percentage is 5.3%. See, that's why the interest rate is 5.3% there. So because the interest rate is relatively low up here, but the bond price is high, because the bond price and bond interest rate move in opposite direction. So at higher price, bond price, or lower interest rate, the quantity demanded of bond is going to happen at point A on the demand curve. And you can read those quantity from down here. These numbers on the horizontal axis are in billions of dollars. So this is saying that when the price of the bond is $950 and the interest rate is low at 5.3%, buyers of bonds or the investors or lenders of funds, they don't want to lend a lot of money. They don't want to buy much bonds because they don't get paid a lot of interest. See, that's why the quantity demanded is only $100 billion. But at the price of $950, if the interest rate is low at 5.3%, that benefits people who are borrowing money. Because the supply curve, remember, represent what? Borrowing. So you can see that at price of $950 or a low interest rate of 5.3%, you draw a line across, you're going to touch the supply curve at point I here. And that means you read the quantity down here. So that means $500 billion worth of bonds will be what? Will be supplied. Okay? So, of course, at this point, at that price and that interest rate, this market is not in equilibrium. The supply is going to exceed demand. So there's going to be an excess supply of bonds here. What we call a surplus. Because supply is going to exceed demand when the price is $950. And this is the size of the surplus, which you can read from down here, would be 500 minus 100. So there's a surplus of $400 billion. And you learn from your economics class, and anytime there's a surplus of something in the marketplace, the market price tends to fall. See the arrow pointing down? Okay? So the market price is going to fall. And when the price falls to 900, the interest rate that corresponds to that 900 is going to be much higher, 11.1%. Because we are reading interest rate in opposite direction. And you can check yourself. If you plug, this is the new price, 900, into this formula, the face value doesn't change, it's still 1,000. So it's 1,000 minus 900 divided by 900. If you use, that's going to be 11.1%. But still, there's still going to be a surplus at that interest rate. But a smaller surplus of 200 billion, because at that 900 price, quantity demanded is what? 200 and quantity supplied is 400. So there's still a surplus of 200. So price will kind of continue to fall until it falls to 850. When the price is 850 again, you plug that price here, 850, this is 1,000. The interest rate that corresponds to that price, 850, based on this formula is going to be what? 17.6%. So at that point, we have reached an equilibrium at point C. Equilibrium is when bond supply equals to bond demand. And then again, any price which is below equilibrium, such as 750, this price for the bond is low here. And now they see that corresponds to a higher interest rate. That's what I say. So when the price is 750, if you plug that price into this formula, 750, face value is 1,000, that interest rate that you're going to get is going to be 33%. Very high interest rate. So if the interest rate is very high, remember the supply of bonds represent borrowing funds. So if I draw a line from 750 or where interest rate is 33%, and I'm going to hit the supply curve at point F, meaning that bond issuers like government corporations don't want to issue a lot of bonds at very high interest rate, because you don't want to borrow money at an interest rate of 33%. So the quantity supplied of bonds is going to be very low at this high interest rate at point F. At one, it's going to be only $100 billion. But at point, when the interest rate is 33%, that favors demanders of bonds, or investors, or lenders of funds. The lenders of funds are represented by the demand curve. So at interest rate with 33% of price of 750, you draw this dashed line across, you're going to hit the demand curve at point E, meaning that $500 billion of bonds will be demanded at that price or at that interest rate. So, but at that point, demand is going to exceed supply. That's what we call excess demand or a shortage. This is the size of the what? The gap, the shortage, size of the shortage or excess demand. The amount by which quantity demanded exceed quantity supplied at that price or that interest rate is going to be $400 billion, because at that price or interest rate, quantity demanded is what? 500, quantity supplied is only 100. So there's a shortage of $400 billion. And anytime there's a shortage of something in the marketplace, it forces market price to go up. So the price of bonds are going to rise. See the arrow pointing up, and so on and so forth. So that's what I introduced yesterday. So now, anytime you change the bond price or bond interest rate, you move along the supply curve or the demand curve. A change in the price or a change in the bond interest rate involves a movement along the demand and supply curve. But now let's go and talk about let's talk about other factors that affect the bond market, which will shift the bond. That's where I was supposed to start from, but I wanted to, because some of you have not yet watched that video, okay? Because this is part 2 of chapter 5. So let's start with the factors that shift the bond demand curve, left or right. So the first factor is wealth, okay? An increase in wealth, if people are becoming wealthy in the economy, and you can think about things that make Americans wealthy. Maybe the stock market is booming, maybe the housing market is doing well, the economy is doing well. If economy is doing well, means most Americans have jobs, they have higher income. Those are the things that increases our wealth. Okay, so when there's an increase in wealth, that means people have money to buy bonds. The demand for bonds is going to shift to the right. So this guy here, that means if you draw something like this, this is my demand, this is a supply for bonds, and this is my demand 1. This is an initial equilibrium. We're assuming that the economy, the bond market was in equilibrium when price P1, interest rate I1 here. And then this is your what? Quantity, equilibrium quantity B1. Okay? So when the supply of wealth, the wealth goes up in the economy, that means people have more money, they're going to demand more bonds. Then the demand for bonds, not the supply, but the demand for bonds is going to shift to the right, like that. So we're in a new equilibrium here. So that's going to lead to higher equilibrium quantity for bonds, and equilibrium price is going to go up to P2. But remember, when price goes up, interest rate falls, because we read interest rate in opposite direction. So an increase in wealth is going to shift the bond demand curve to the right. That's going to lead to an increase in equilibrium quantity, an increase in equilibrium price, but a decrease in what? In equilibrium bond interest rate. Okay? And the converse is true. What about if Americans were losing wealth, maybe due to a bad economy, or maybe the stock market sucks, or we're losing money because our housing is losing value, the real estate. So if the wealth in the economy is decreasing, meaning that people don't have enough money to buy bonds, then the demand for bonds would shift to the left instead. You know that. If the demand curve shifts to the left, that's going to lead to a lower equilibrium bond price and lower equilibrium bond quantity. But interest rate would go up, because bond price and bond interest rate move in opposite direction. So that is point number 1. That's one factor that shifts the bond demand curve. The second factor that shifts the bonds demand curve is going to be expected returns. Okay? Let me open and draw, actually keep drawing those graphs so that you see what I'm doing here. So okay.
Hey, Professor,
So
I had a question about the test today.
go ahead. The what?
Oh, on the syllabus, it just says there's a test today, and I wasn't here last class. Is it moved at all?
Yes, yes. There's no test today. I made that very clear in our previous meetings, and I've been making that point clear every video lecture that I posted at Canvas. We moved the test on until Monday because I felt like Friday was too short. You know, it will not give you guys enough time to watch those videos and maybe be able to get ready for the test. At least if I gave you guys a little bit like a weekend to study, that would give you a little bit window to do well on the exam. That's the reason why we move it to Monday.
Okay, thank you.
No problem. Yeah. So the test is on Monday. Okay. So let's talk about this. We're trying to discuss now the factors that shift the bond demand curve. So the second one is expected return. So when we're talking about expected returns here, you have to compare the expected returns on bonds with expected returns on all other assets that you could buy. So we're going to say where you are going to demand more bonds if the expected return on the bond market has increased more than the expected return on stocks and any other thing. And the one thing that will make you returns go up is higher interest rate, which will affect expected return, especially for long-term bonds. Because in chapter 4, there's something we did. We say that the rate of return on a bond investment has two component parts. It's the yield, the guarantee yield on the bond, plus the rate of capital gains. And this rate of capital gains basically is the percentage change in the price of the bond. That's how you calculate the percentage change in price T plus 1, price of the bond, 1 period from today minus the price today divided by price today is a formula you use for calculating the rate of capital gains. And then this I is basically the coupon payment you get on the bond expressed as a percentage of the bond purchase price. If you haven't watched chapter 4 material yet, we talk a lot about this. And we say that anytime interest rate goes up, it affects the expected return. So the rate of capital gains is going to fall. Because since bond price and bond interest rate move in opposite direction, an increase in interest rate is going to lower the rate of return on long-term bonds because the rate of capital gain is going to go down significantly. Okay? So that means we're going to say that if we're going to say higher interest rate lowers expected returns on long-term bonds, shifting the demand to the what? Shifting their demand to the left. Because if the return is falling, nobody want to buy those bonds. Demand to the left. And vice versa. Vice versa means if interest rate were to fall, lower interest rate would actually increase the expected returns on long-term bonds. That would shift the demand for bonds to the what? To the right. Okay? So the demand, so if you draw your graph here, we're saying that if you put price on this axis and interest rate, and we're talking about equal quantity here, this is your bond supply curve, this is your bond demand curve, B1. So this is B equilibrium quantity, P1, there's a corresponding interest rate, I1. So what I'm saying here is that if the interest rates increase in the economy, interest rate on bonds, that's going to lower the long-term, the expected return on long-term bonds and shifting their demand to the what? To the left. So the new equilibrium is going to be where the red line intersects the blue line, which is this point here. That's going to lead to a lower equilibrium quantity of bonds and lower equilibrium bond price, but interest rate would what? Would increase because we read interest rate in opposite direction. Okay, so that's exactly what happened. And the converse is true. If interest rates were falling, lower interest rate is gonna increase the expected returns on bonds, long-term bonds, shifting the demand curve to the right instead. So that will lead to higher equilibrium bond price, higher equilibrium bond quantity, and what? And lower interest rate. Okay? And then so the third factor which affect the demand for bonds is going to be expected inflation. Expected inflation. Okay, so think about it. Let me ask you, Daniel Open, if expected inflation goes up, how does that affect your return on your investment? If you are expecting inflation to go up,
the return would go down, wouldn't it?
it goes down, yes, the real return. And how do we know that? We use what we talked about, the Fisher equation, which is the link. There's a link between interest rate. The real interest rate is what you look at when you invest funds, which is written as IR equals to nominal interest rate minus expected inflation. So this pi stands for expected inflation. The real interest rate is the inflation adjusted interest rate. This is what, when you buy a bond, this is what the government quotes for you, or the corporation that issues you that bond. They're going to say, oh, you buy this bond, we're going to pay you 10%. But they never tell you that throughout the course of when you're holding that bond, that investment, inflation could affect the what? Affect the value of that interest rate. So that means the relevant interest rate that you as an investor should look at is this guy here, which is the what? The real interest rate or the real return. So when expected inflation goes up this pi here, that means, and nominal interest rate, that's, because you're guaranteed that's a rate, that's going to decrease what? The real return on your bond investment. So if your real return is going down with inflation, you don't want to buy that bond, do you? Do you want to buy bonds if your real return would go down, Daniel?
No.
Okay, so that means a rise in expected inflation, which lowers the return, the real return on a bond investment, is going to shift the what? Shift the bond demand curve to the left. So this is price, this is bond interest rate, this is quantity. So if this is my initial bond supply curve, this is my bond demand curve. What I'm saying is that we have seen reading that equation. This is P1. There's a corresponding interest rate, I1. Okay, so what we're saying here is that if expected inflation goes up, it lowers the real return on a bond investment. So people don't want to buy those bonds with lower returns. So this thing's gonna shift to the what? To the left. Okay, so the new equilibrium is where the black line intersects the blue line. So that's gonna lower equilibrium quantity of bonds, and it's gonna lower equilibrium price for these bonds. But interest rate is gonna what? Is gonna rise, because when we read interest rate in the opposite direction. Okay, so the result here is that interest rate is gonna increase, price of the bond is gonna fall, but equilibrium quantity is gonna fall as well. That's what you see here. And the converse is true. What about if expected inflation was supposed to decrease? That means people are expecting a higher return, real interest rate on their bond investment. That would actually shift the bond demand curve to the right. And that would lead to, if you shift the bond demand curve to the right because of a lower expected inflation, which raises a real return on your investment, equilibrium would be somewhere here. So equilibrium quantity would rise, equilibrium price would rise, and interest rate would fall. It would be the opposite effect of what you got here. Okay. And then the other factor, this is straightforward, risk. If the bond market is becoming risky compared to any other market, what do you think is going to happen to its demand? Hey guys, I'm asking you a question.
Demand will go down.
Will it go down?
Yeah, demand will go down because for the investors in the marketplace, typically risk averse. Risk averse means they hate taking risk. Okay, so if somebody tells you that, oh, bond market is becoming very risky, there's a greater chance that you're going to lose all your money, okay, or most of your money. People don't want to buy that because it's risky. This is a much bold pen here. Okay, so you have your initial bond demand curve here, and then your bond supply curve here. So what I'm saying is that if this was your initial equilibrium quantity for bond, this is the initial equilibrium price with a corresponding interest rate. Okay, if the bond market becomes risky, people are gonna what? The demand for bond is gonna shift to the left, to B to D. That's gonna lower both equilibrium quantity and equilibrium price, but interest rate will also fall. There you go. But if the bond market becomes less risky, then the demand will shift to the right. So it will have the opposite effect. And then the final factor that will affect the bond, the supply, the demand for bonds. Then I'm going to talk about what shift the supply for bonds is going to be liquidity. People want to buy. Liquidity is how easy an asset can be converted into cash. Okay, so when you're investing in an asset, you ask yourself, how easy is it that I can sell this asset in the future if I need money? Most investors don't want to buy an asset where you buy it and you're stuck with it. It's very difficult to liquidate. And so is bond. There are different bonds that are issued by different corporations. If you buy a bond in some corporation that nobody ever heard about, and you want to sell that corporate bond, nobody may want to buy those bonds. The US Treasury bond is always the most liquid investment out there. It's very easy to sell the US Treasury bond. So the idea is that the higher the liquidity of a bond, the higher is the demand. So the demand, I don't have to draw this. This is just straightforward. So you're going to draw like we have been doing the initial demand and supply for bonds. Like here's your bond supply, bond demand. So when we say the bond is high, higher liquidity means the demand for bond is going to shift to the right. That is going to increase equilibrium quantity and equilibrium price, and interest rate would fall. And the converse would be true. Lower liquidity would shift the bond demand curve to the what? To the left. Lowering equilibrium quantity and equilibrium price, but raising interest rates. Okay. So those are some factors which affect the bond demand curve. But I want you to be a little bit conscious here. Conscious in a way that when I talk about wealth here, there are things that drive wealth. For example, I talked about here in an expansion. Expansion means business cycle expansion. During business cycle expansion, when the economy is growing, Americans have more wealth because people have jobs. But during business cycle recession, when a question was say recession here, the wealth would be decreasing. So we'll shift the demand curve to the left. Okay. So now let's discuss. No, those are the factors that shift the bond demand curve. I talked about them already. These 5. Now let's go and talk about the factors that shift the bond supply curve. Shifts in the bond supply curve. So the supply of bonds are going to be shifted to the left or right. Just 3 main factors. Okay. Remember, who are the suppliers of bonds? The suppliers of bonds are going to be government, both federal government, municipal government, or local, state and local governments, and then corporations. And the suppliers of those bonds, these agencies I've named, are the borrowers of funds. Anytime you're supplying, you're issuing bond, you're borrowing funds. So Peyton, when I ask you a question, why would a corporation want to borrow funds? Want to borrow more funds by issuing corporate bonds?
To leverage their money.
Leverage your money, but there could be something. What about if somebody tells you that you own a company and somebody tells you that, oh, there's going to be increased prospect for profitability? That means the company needs to expand its activities, right? To take advantage of that, correct?
Right.
Yeah. And one of the things that if the corporation doesn't have its own savings, they are going to issue corporate bonds. to raise money so that they can expand and take advantage of the profit opportunities that exist. That's what I'm saying. So that's the first point here. Expected profitability of investment opportunities in an expansion when the economy is doing well means that the supply of bonds is going to shift to the right. Many corporations want to take advantage of that by what? By issuing treasury bonds. Sorry, corporate bonds. So this is a bond supply one, bond demand. So you see, so this is going to be B, P1, I1. Okay? So when there's an increase in profitability, corporations want to supply more bonds. So that's going to lead to an increase in the supply, shift to the right. So the new equilibrium is going to be where the black line intersects the blue line. That would lead to an increase in equilibrium bond quantity, a decrease in equilibrium bond price, and a corresponding increase in interest rate. And the converse would be true. If we expect profitability of investment in the economy in a recession to fall, no company want to expand when they're expecting lower profitability. So companies would actually downsize instead. That means they would issue less corporate bonds. So the supply of bonds in that case will shift to the what? Overall will shift to the left. Okay, so that's point number one. Then point number two is expected inflation. Okay, now we remember we just talked about that expected inflation shifts the bond demand curve. So it turns out that expected inflation can actually shift both the bond demand and bond supply curve. Okay, because think about it. Let me write that formula that I wrote earlier on. We say that the real return or real interest rate on your investment, you take nominal interest rate minus expected inflation. And we say that when inflation goes up, expected inflation, it lowers the return on your bond investment. So if you are the buyer, you're the demander of the bond, you are going to be shifting the demand curve to the left. But what about if you're the supplier of the bond? The supplier of the bond, remember, is the what? Is the borrower of funds. Okay, so when expected inflation goes up, that actually is good for borrowing funds because that's going to lower the what? The real interest rate, the burden of the debt. Does that make sense, Payton?
Sort of.
No, it makes sense. I want to explain it again. Don't say sort of. So we have two types. We say that the bond suppliers of bonds are what? These are borrowers of funds. But the demanders of bonds are lenders of funds or investors. People who are investing money. When you're buying bond, you're investing money. You're lending funds. So you want to get paid a higher return, real return on your investment. And one of the things that might drive down that return is inflation. When inflation goes up, the real return, the real interest rate on your bond investment falls. That's why we say the demand curve for bond would shift to the left. But that is going to be the opposite effect on supply because when you're supplying bonds, you want to pay back a lower real interest rate. Does that make sense?
Yeah, that makes sense.
Since you're the borrower. So that means when expected inflation goes up, that lowers the real interest rate on bonds. The suppliers or the borrowers of funds want to what? Want to supply more. They want to borrow more because they're going to be paying less real return on that what? On that borrowing. So in other words, so that means the supply, this gonna while the demand for bond would shift to the left with an increased expected inflation, the demand for bond shifts left, the supply for bond would actually shift to the right. So the question is, how do I know if I say there's an increase in expected inflation? How does this affect equilibrium what? Price, interest rate, and equilibrium quantity. So because what? So the first thing that you're gonna do here, you're gonna analyze three cases for you to be able to concretely tell what happens to equilibrium what? Equilibrium interest rate. Because we know when expected inflation goes up, that we just talked about it. Bond demand shifts what? left, but bond supply shifts what? Shifts to the right. But we don't know by how much they shift. So you need to draw. So let's talk about case one. Case one, you can assume that, let's assume that bond demand shifts more than what? It doesn't matter which one you call case one. You could also start with bond supply shifts more than bond demand. So let's start with bond demand shifts more than what? Bond supply. So then this case is going to look like this. So you put price here, you put interest rate here, you put quantity here. So here's my bond supply one, and then this is my bond demand one. Before anything happened, before there was a change in expected inflation, this was equilibrium bond quantity, and then this equilibrium price, P1, corresponding interest rate, I1. And then what we're saying is that there's an increase in expected inflation. We know the bond demand curve is going to shift to the left, but the bond supply shifts to the right. But we're assuming in this case that the shift of the bond demand curve to the left is going to be more than the shift of the bond demand supply curve to the right. That's what that means. So you're going to draw this case. So that means the shift of the bond demand curve to the left is bigger in terms of the magnitude of the shift, bigger than the shift of the bond supply curve to the right. See what is this? What I mean? See the bond supply curve shifted to the right just somewhat, but it's a big shift of the bond demand curve. So under this case, the new equilibrium is going to be where the two black lines intersect, where the new demand curve and the new supply curve B2 intersect. Two black lines intersect at this point. So under this case, equilibrium bond quantity is going to fall. Equilibrium bond price is going to fall, meaning that interest rate is going to rise. So under this case, you can summarize, we know that our interest rate is gonna increase, price is gonna fall, and quantity is gonna fall as well. Okay, but that's not the fun. So let's go look at the second case. So the second case, we're gonna flip that one. Bond supply. Let's bond supply shift more than bond demand, because we want to be able to concretely tell what might happen to what? Equilibrium quantity and equilibrium price and interest rate. Let me open a few blank sheets here so I can draw my diagram. So case two, we are going to assume that bond supply shifts more than bond demand. Remember, first case, we assume bond demand shifted more than bond supply. What about this case? What if you assume that what? The shift of the bond supply curve to the right outpaced the shift to the left of the bond demand curve. Then we have something like this. So you got price here, you got interest rate right on this axis simultaneously, then you have equilibrium quantity here. So if this is my initial bond supply curve, and this is my initial bond demand curve before expected inflation went up, this is going to be your P1 corresponding interest rate I1. This is initial equilibrium quantity. So we know that when there's an increase in expected inflation, the bond supply curve shifts to the what? To the right, and the bond demand curve shifts to the left. But in this example case, we're assuming that what? The shift to the right of the bond supply curve is more in the magnitude of the shift, more than the shift to the left of the bond demand curve. So the new equilibrium is going to be where the two black lines intersect, where the new supply curve intersect the new demand curve, which is going to be this point here. So that's going to lead to an increase in equilibrium bond quantity and a decrease in equilibrium bond price with a corresponding increase in what? In bond interest rate. So you can summarize here. It's clearly we can see that what? Equilibrium bond quantity is going to go up. Interest rate is going to increase. Bond price is going to fall. Okay? Then the last case is a case where you're going to assume that both bond supply and bond demand shift proportionally by the same magnitude. Okay? So case three, you're going to assume that bond supply and bond demand shift by the same magnitude. So I'm going to draw this. I put price here, I put interest rate, I put quantity of the bonds here. So this is my initial bond supply curve, initial bond demand curve, initial terminal equilibrium quantity, B1, P1, I1. Okay, so we're assuming that we know bond demand curve shifts to the left when there's an increase in expected inflation, like that. Bond supply curve shifts to the right, but we're going to assume that it's shifting by the same magnitude as a shift of the bond demand curve, B2S. So you can see under this case, because the magnitude of the shift is proportional, there's going to be no change. The new equilibrium is where the two black lines intersect. Under this case, there's no change in equilibrium quantity because this was the initial equilibrium. This is now the new equilibrium. Quantity doesn't change. Are you guys seeing, Ben and Daniel?
That makes sense.
Yeah.
There's no change in quantity, but equilibrium bond price is going to fall still. And interest rate is still going to increase. So here we're going to say, under this case, B is unchanged. There's no change in what? In equilibrium quantity, but bond price falls. We put an arrow taking down means falls. Interest rate is going to rise. Okay? So now we can summarize. So under all three cases, when there's an increase in expected inflation, you see the first case here is that interest rate rises, price falls, bond equilibrium quantity falls. Under the second case, bond price is going to fall, interest rate rises, equilibrium quantity is going to increase. Under the third case, bond price still falls, interest rate rises, but there's no change in what? Then now we can conclude by saying when there's an increase in expected inflation and nobody tells us exactly which side of the market is affected more, whether demand or supply, the overall conclusion has to be that an increase in expected inflation, okay, it means that bond price always decreases. In all three cases, you found that bond price decreases. Bond interest rate increases. But the change in equilibrium quantity is ambiguous. Ambiguous means uncertain. In other words, you could say equilibrium quantity either increases, decreases, or stays the same. That's why we're calling it ambiguous. So you guys see how we analyze this? Okay. So that's for an increase in what? In expected. If the question was phrased, what about when expected inflation decreases? That's going to be the opposite. That means the bond demand curve would be the one shifting to the right and the bond supply curve would be shifting to the left. You get the opposite. But then you still have to draw three cases. Case one where you assume bond supply shifts more than bond demand. Case two, bond demand shifts more than bond supply. And then case three where they shift by the same magnitude. So you're going to get the opposite of what we found here. That would be, in that case, equilibrium quantity would what? When you say the bond demand curve is shifting to a left, bond supply curve, equilibrium quantity might what? Might fall. But equilibrium price is going to be either increase, decrease, or stay the same. And equilibrium interest rate would be the same thing too. Increase, decrease, or stay the same. Okay. Then there's the last factor that affects the supply of bonds is government budget. That would shift the supply of bonds. Do you know that the United States government is a major player in the bond market? because of the size of our debt. The debt is at $36.5 trillion. Every year, when America incurs a deficit, that adds onto the debt. How does the United States borrow money, Peyton?
Issuing treasury bonds.
By issuing treasury bonds. So if let's say the United States government in 2024 collected tax revenue of $4 trillion, but they want to spend $5.5 trillion. That means they don't have $1.5 trillion. That's a definition of a deficit. When government spending is more than what tax revenues collected, then the government is going to finance its deficit by issuing treasury bonds. So when the government government is financing a large budgetary deficit, the government will be issuing a lot of treasury bonds. That's going to lead to an increase in the supply of bonds in the bond market. But if the government, so the government increases its budget deficit, that means the government is going to be issuing a lot of bonds to finance that deficit. Does that make sense? Daniel, can you hear me? You guys are muted.
Yeah.
You guys can leave your phone unmuted because we're not many here. So when I ask, you don't have to struggle unmuting. Just leave it unmuted, So when the government increases its budgetary deficit, that means they're going to increase issuing of treasury bonds because the government finances deficit by issuing bonds. So the supply of bonds overall is going to shift to the right. So I don't have to, you can draw that. So with this, if the US government decides to increase this PI, this is bond quantity here, this is B1S, this is BD. So this is initial equilibrium before the government increases budget, and then this equilibrium price and interest rate I1. So what I'm saying is that if the US government decides to increase budgetary deficit, that means they're going to issue more bonds. The supply of bonds is going to shift to the right. So that's going to lead to the new equilibrium where the red line intersects the blue line. So that means equilibrium bond quantity is going to increase, bond price is going to fall, and interest rate, the yield on the bond is going to increase. And the converse is true. If the government was decreasing its budgetary deficit, that means the government is going to be downsizing its budget. They're not going to be issuing, they're going to decrease the issuing of bonds. The supply of bonds is going to shift to the left. So the equilibrium would be here. It would lead to higher bond price, lower bond interest rate, and lower equilibrium bond quantity. Okay? So when we go here, so here was one example that we talked about expected inflation, remember? So I said if expected inflation increases, it shifts both the bond demand and bond supply curve. But on your slide here, I only drew one case, a case where the shift of the bond supply curve to the right is equal to the shift by the same magnitude. I only drew case 3. But overall, if you remember, all those 3 cases, whether bond demand shift more than bond supply, or bond supply shifts more than, if anytime there's an increase in expected inflation, it leads to a decrease in equilibrium price and an increase in bond interest rate. Because I did not put interest rate here. You can add it here. There's I1 corresponding to P1. There's I2 because I didn't want to convolute this diagram. Okay, so interest rates are going to rise when there's an increase in expected inflation. Interest rate on bonds. Then equilibrium price of bond is going to what? Is going to fall. So that means exchanges in expected inflation in the marketplace is a good predictor of bond interest rates. Anytime the market is expecting that inflation is going to go up, then bond yield is going to rise immediately. So, and the data matches that prediction very well. So these are actual data for the United States bond market from 1960, 50s to more recent times. So the blue line is the trajectory of expected inflation in the United States. And the red line is the interest rate on bonds. Look at how they map very well, because our prediction is that anytime there's an increase in expected inflation, bond price goes down and interest rates are going to rise. And you can see interest rates are going to they rise and fall with what? With expected inflation. This is the actual data. And then this is an example of a business cycle. Okay, so another point that you could also make is that we talked about when the economy is doing well, it can affect both the supply side and the demand side of the bond market. Yes, you can argue that. So when economy is expanding, okay, first of all, more wealth get created. You know that, Peyton, right? If the economy is doing well, what we call business cycle expansion. Business cycle expansion means the economy is growing economy.
Right.
So if the economy is growing, it means many Americans have jobs. It means the stock market is doing well. Markets are doing, so people get wealthier during a growing and an expansionary economy. And once people are doing well, that means they have money to buy the bonds. So the demand for bonds will shift to the right. And then at the same time, when the economy is growing, it means there's increased prospects for profitability. Does that make sense?
That makes sense.
Economy, if you own a business, you better run the business in a growing economy than in an economy which is going through a recession, downtime. So that means if the economy is growing, it's going to shift both the bond demand and bond supply curve, because if it increases prospects for profitability, companies are going to expand to take advantage of that profit opportunity. And they expand by issuing corporate bonds. That's why the supply of bonds is going to shift to the right. But this is what we normally observe in the economy. Anytime the economy is growing, okay, or expanding, the shift of the bond supply curve is always outpace the shift of the bond demand curve. So a new equilibrium is going to be at point 2. That's going to lead to higher bond equilibrium. If you locate this initial equilibrium quantity is going to rise, equilibrium price falls, and interest rates are going to what? Are going to rise. So then, okay, so now there are two things that can predict interest rate on bonds. And you guys are going to be investing money. The first one is expected inflation. We talked about it. Higher expected inflation drive up the what? The interest rate on bonds. Lower expected inflation drive down the interest rate on bonds. And then the second prediction is business cycles. When the economy is growing, that is going to lead to what? Increase in interest rates. When the economy is on bond interest rates are going to rise when the economy grows, but they're going to fall when the economy goes to a recession. And turns out that that's a very good predictor here. So you see, you guys see my diagram here?
Yes, sir.
This is an actual
Yes.
diagram. You see these pole-looking lines? They look very small. You see those pole-looking lines? There's a couple of them. Those are the times when America experienced economic recession. Meaning that anytime in between those pole-looking line like these points here, this in between any 2-point line, it means the economy is growing. So when anytime the economy is growing, you see that corresponds with rising interest rate on bonds. And again, so when you hit a pole-looking line, the interest rate falls. See, so business cycle recessions are a good predictor of interest rate on bonds and business cycle expansion as well. When the economy goes in a recession, interest rate on bonds typically fall. But when the economy is growing, interest rate on bonds typically rises. Okay. Now we're going towards now. Okay. Now that concludes my bond supply and bond demand analysis. So the most takeaway from this up to this point, you just need to know the factors that shift the bond supply curve to the right or to the left, the factors that shift the bond demand curve to the left or to the right, and how that affect equilibrium price, equilibrium interest rate, and equilibrium quantity of bonds. That's very, very simple. Okay. Now let's talk about another framework. A framework that was developed by John Maynard Keynes. So we're going to talk about the supply and demand in the market for money, what we call the liquidity preference framework. It was developed by John Maynard Keynes. So when John Maynard Keynes wrote his book in 1936, a book that kind of like set the revolution in the economic profession, he dedicated a couple of chapters of that book writing on the concept of interest rate, the money market. Okay, so when Keynes is writing about the money market, he calls the money market analysis the liquidity preference theory. Or the liquidity preference model, if you want to call it model or theory. So this is basically the money market. So when Keynes developed his model, he developed a very simple model. He argues that people hold, okay, that the people hold their wealth by either holding money or bonds. It's a very simple model because, you know, when you're holding money, money does not pay you a return, does it, Daniel?
What was it?
Does money pay you a return? If you keep $1,000 under the pillow at home from January 1, 2025, and you wake up on December 31, 2025, has that money grown?
No.
Okay, so when you're keeping money, you're holding money. Money does not pay you any interest. It does not earn you any return. But if you invest the money in bonds, bonds earn you interest. Your money would grow when you invest it. It doesn't grow when you keep it at home or under the pillow or in your wallet. But you know, but so some people criticize Keynes. They were so naive to criticize Keynes that Keynes is so simplistic to argue that our wealth is only kept in terms of money. Then what about real estate? What about stocks? What about gold? Some people invest. What about people? Some people invest in livestock, land. So Keynes argues that when he talks about bonds, he's using this in generality, that these bonds is going to represent every asset out there, which include bonds itself, stocks, real estate, that earn you a rate of return. Okay, because he didn't want to have so many variables on the right. So now, because we like to talk about demand and supply side, he's going to say that the wealth, the supply of wealth in the economy, which we're going to denote as wealth. So WS is going to be what we call supply of what? Of wealth. Is going to be equal to the supply of money, which we can represent as MS. MS stands for supply of money in the economy. Plus the supply of bonds, which is BS. Bond supply of bonds. So he calls this is a supply side of the economy, according to Keynes. The total supply of wealth in the economy comprises of supply of money and supply of what? Supply of bonds. And then you're also going to talk about, describe, what about the demand side? So let's talk about the demand side here. So on the demand side, Keynes is going to argue that the demand for wealth consists of the demand for money, MD, money demand, and the demand for bonds. So we are going to reach equilibrium Equilibrium is when what? The supply of wealth equals to the demand for wealth. But remember, we said that the supply of wealth, WS, is given as money supply plus the supply of money plus the supply of bonds. So when we substitute that here, the supply of wealth is given as supply of dollars and the supply of bonds. Then we set it equal to the demand for wealth is going to be equal to these two. So that's equal to MD plus BD. That's in equilibrium, according to Keynes. So now, if we assume that the money market is in equilibrium, that MD equals to MS. The money market is in equilibrium when the demand for dollars in the economy equals to the supply for dollars. Then according to Keynes, anytime one of those two markets is in equilibrium, the other market will automatically be in equilibrium. Let me do here. So we're saying here, we're saying MS plus B. Let me duplicate it because I ran out of room. Equals to MD plus BD. So if the money market is in equilibrium where money supply equals to money demand, look here, guys, the bond market will also be in equilibrium. So first of all, if I collect like terms, first collect like terms, put terms in money together. So if I subtract money demand from both sides and subtract bond supply from both sides, then I can write this equation as MS minus MD must equal to BD minus BS. So when we say money supply is in equilibrium, meaning money supply equals to money demand, that means the difference MS minus MDD is going to be 0. Therefore, that means BD minus B to the S equals to 0. So I take B. So that means the bond market will also reach equilibrium according to Keynes. Okay? So this Keynes actually derived this based on some framework which was developed by some French economists called Walras. We call it the Walras law. The Walras law basically says that in an economy with N markets, N could be 150, whatever it is, N markets, if N minus 1 of those markets reach equilibrium, then the last market, which you can call it the nth market, will also be in equilibrium. In our case, we have two markets. We have the bond market and the money market. So if N minus 1, 2 minus 1, if one of the two markets is in equilibrium, then the second market will be in equilibrium. So in other words, Keynes then argues that there's simultaneous equilibrium in the money market and the bond market, that the bond market and the money market will reach equilibrium simultaneously, and the interest rate that is determined in the bond market will be the same interest rate that determined in the money market. So in chapter 19, we say that the money market, okay, let's first draw the bond market. So bond market framework. Here. I'm going to talk about, then I'm going to draw it side by side with money market, which Keynes call it what? The liquidity, can call it the liquidity preference what? Model. Okay. So here we have what? Keynes is arguing that you have P, I here, and then here you have the money market. We put interest rate here. Remember okay, and versus what? The quantity of money. Here's quantity of bonds. The supply of money in the marketplace is what is determined by the Federal Reserve. So the money supply is controlled by the central bank. Then the demand for money is downward sloping. When interest rates are high, people hold less money. They demand less money because they lose money by what? That's why there's an inverse relationship between money demand and interest rate. So if money market reaches equilibrium here, determines this interest rate. This is going to be equilibrium what? Level of money in the economy. So Keynes is arguing that the same interest rate that get determined in the money market is the same interest rate that get determined in the bond market. Because remember, the bond market reaches equilibrium when you read interest rate and price simultaneously. The bond market reaches equilibrium when bond supply, which we call B to the S, intersect bond demand. That determines equilibrium bond quantity here. Pedro, are you guys seeing this?
Yes, sir.
Okay, so here's what Keynes is arguing. Let's say, suppose an interest rate becomes very high in the money market, like I2. Is the money market in equilibrium when interest rate is I2?
No.
What exceeds what? If you draw a line across from that interest rate I2, you hit the what? Money. This is a money demand curve, meaning that the money demand would be right here. But you continue drawing a line, the money supply curve is here. So that means there's going to be excess what? A surplus of dollars in the economy. We call it excess money. Excess money supply. So I want to ask you too, when there's an excess supply of dollars in the economy because interest rate is high, what do Americans do with that excess supply of dollars? Let's just say all of us have already met our spending. We spend all, but we still have some excess. Let's say your family paid on us an excess of $100,000 after meeting all your expenses for the year. What do you do with that excess money?
No, you can either save it or invest it.
Yeah, and invest. And there are only two markets. You're investing in what? Look at the market on the left. You're
In the
investing in
bond-
what?
In the bond market.
In the bond market. So according to John Maynard Keynes, anytime there's an excess supply of money in the economy, people are going to use that excess supply of money to buy bonds, to invest in the bonds. So that means the demand for bonds would shift to the what? Will shift to the what?
To the right.
There you go.
That makes sense.
Okay, so that is going to raise equilibrium bond price to P2. And interest rate, remember when bond price rises, what happens to interest rate? Because we read them in opposite direction. What happened to interest rate?
We go down.
They go down. So Keynes is arguing that if you have a disequilibrium in the money market where interest rate is above here, people are going to buy bonds, and that eventually is going to lead to an increase in bond price and lower interest rate. So this interest rate eventually is going to fall back to equilibrium. Because when people buy bonds, equilibrium bond bond demand shifts to the right, bond price goes up, interest rate falls. So interest rate is going. That's how interest rates are going to fall back to equilibrium. And conversely, if we have a very low interest rate like I0 in the money market here, when the interest rate is I0 here, is the money market in equilibrium? No. Demand in this case, if I draw a line across, this is gonna be you hit the money supply curve first before you hit the money demand. So this gap here is what we are calling what? There's gonna be a shortage of money. Any interest rate in the money market which is below equilibrium, it means money demand exceed money supply. So there's a shortage of money. And anytime there's a shortage of money in the economy, Peyton and Daniel, what do people do to get money? Let's say your family needs 20, you wanna spend 80,000, but you only have 60,000. But you have a lot of investment in the bond market. What do you do to your bonds to get money?
Sell it.
You're gonna sell your bonds. So you see the logic. So when you sell the bonds, selling bonds means issuing bonds. That means the supply of bonds is gonna shift to the what? To the right. When people have a shortage of money, they're gonna liquidate their bonds to get money. So as they sell the issue bonds, the supply shifts to the right. That's gonna lower what? Equilibrium bond price, and interest rate is gonna what? Rise. That's how interest rate will rise back to equilibrium. So Keynes says that those two markets, bond market and money market, you can put them side by side to determine what happens to interest rate. Okay, now let's dig a little bit deeper. So this is how the money market look like according to Keynes. All right. What about the money? Okay, the other thing that we can talk about, what are the things that shift the money? Let's talk about the money market a little bit more. Then we can discuss again additional theory by Friedman. Then we're going to be done, more or less. So you have something like this. So if we're saying interest rate, so the money market, this is the supply of money is controlled by the Federal Reserve. You guys know this. The Federal Reserve is the one that print dollars. So if this is your interest rate, I1, okay, but let's talk about shifts in the money demand curve. What factors will make American demand more dollars? There are only three of them. One of them is going to be the price level. Okay, so if things are becoming more and more expensive, the price level goes up, what happens? People are going to demand more dollars to go shopping, right, Daniel?
Yeah.
Yeah. So 5 years ago, if your family went to HEB, you went with $100, you could actually buy groceries. You go with $100 today, you may not get groceries. That's just a fact, because things have become expensive. So if your family wants to buy the same amount of groceries they were buying 4 or 5 years ago with the same amount with $100, They need now probably $300. They need to demand more dollars. So anytime price level increases, the demand for money is going to shift to the right. Okay? So interest rate is going to rise. And the converse is true. If price level falls, people, you don't need a lot of money to go shopping. People are going to demand less dollar. The demand curve will shift to the left. And interest rate would fall. The second factor is the income level. If the income of Americans are going up because the economy is doing well, people have jobs, that means people are going to demand more dollars, right? Does that make sense? Than when they don't have it.
Yeah.
Peyton, remember, in a bad economy, if there's high unemployment, that leads to a lower income in the economy. So if there's low income, then people can go shopping. They can't demand money to go. You can't demand what you don't have in the first place. Does that make sense?
Yeah, that makes sense.
So when the income level of Americans are rising because of good economy, that's going to shift the money demand curve to the right. That means more and more Americans will demand more dollars to go shopping. Okay, so there's going to shift. It's the same way the graph has shifted here. So then the last one is expected inflation. Okay, when your family, Peyton, is expecting prices to be, inflation to be rising in the future. Let's say somebody says that inflation next year, 2026, is going to be way worse. What do they need to do today? Let's say your family was planning to buy electronics, buy a car, and somebody says that in 2026, the cars are going to be 30% more expensive than it is in 2025. That means expected inflation is coming to the United States. What do you do today?
Save more money.
No, you buy today when it's still cheap.
Oh, I got you.
Yeah. So when we expect inflation to be coming in the near future, we are going to be buying today when things are still cheap. So by us wanting to buy today, we need money to buy today. So that's going to lead to an increase in money demand to buy to make our purchase today when things are still cheap. So an expected increase in inflation leads to an increase in the demand for goods and services and the demand for money today. So the demand curve is going to shift to the right. But lower inflationary expectation, when people say inflation is going to fall in the near future, means that we have to postpone our purchase because things are going to be cheaper in the future. Okay. So anyway, so these are the three factors. So now, what I want to talk to you guys, Keynes, the Keynesian model. When John made that model that Keynes talked about, which he developed this model, Keynes is going to argue that all these three factors will be held constant when the Federal Reserve prints money. So Keynes okay, so let's talk about the liquidity effect of changing money supply or of printing money, of changing money supply according to Keynes. John Maynard Keynes. So Keynes argues that an increase in money supply by the Federal Reserve, money supply, because the Fed is the one that can print money, comma, ceteris paribus. Ceteris paribus is is a Latin word that means all other things held constant, will lead to a decrease in interest rate. And vice versa. Okay, so this is what Keynes is doing. He's saying that when the Federal Reserve prints money or increase the money supply, so put interest rate here. This is the what? We can call this money supply 1. This is your money demand curve, which slopes downward. So this was what initial interest rate I1. So according to Keynes, the liquidity effect is that when the Fed is printing money, the supply of money is going to shift to the right. Oh, I need a different pen so I see the color. It's not going to look well. Sure, get different color. I need a different color that you can see there. Otherwise, let me see this green. Yeah, that's better. So this is M2. So the new equilibrium is where the green line, the new money supply line, intersect the what? The money demand. So interest rate would fall, according to Keynes. This is, an increase in what? Effect of what we call it the liquidity effect of increasing money supply. It's going to lead to lower interest rate. And the converse is true, according to Keynes, that if the Fed decreases money supply instead, so liquidity effect of decreasing the what? Money supply, according to Keynes. So we're going to have something like this. Interest rate, quantity of money on this axis. This is the initial money supply. You can call this MS1, M1 here. Money demand curve. Okay, this was initial interest rate. So according to Keynes, if the Fed decreases the money supply curve is going to line shifts to the left, to like M2S. So quantity of dollars, it decreased from M1 to M2. Interest rate is going to rise. Okay, let me ask you guys a question. Is this prediction, is this what we see in the data? That when we see the Federal Reserve printing money, the printing of money should lead to what? To a decrease in interest rate? Shouldn't we predict the other way around?
That's what I thought.
Yes. Okay. So what does that tell you? What did Keynes do to make him come up with this bad prediction? Is holding other factors what? Constant. Okay. So that prompted Milton Friedman from the University of Chicago to criticize Keynes and saying the Keynesian model does not predict the way we want it to predict because it's missing some point. Okay. So Friedman. So let's talk about it. Yeah. Let me open a new slide. So let me talk about it. So Friedman is arguing that, so let's talk about Milton Friedman. You guys heard about Milton Friedman? The late great Milton Friedman from the University of Chicago?
I've never heard of him.
No, me neither.
One of the best economists to ever live. So in the 1950s, Friedman criticized Keynes. Friedman argues that the assumption that we hold all else equal or all else constant, that's what we call ceteris paribus. The Latin word ceteris paribus means you're holding all else equal. So the assumption that we hold everything else equal, or ceteris paribus, by Keynes, when we change the money supply, when the Fed changes the money supply, is wrong. because money affects so many other variables in the economy, affects many other variables. So here's what Friedman is saying. Friedman is saying that, remember, we talked about the factors that shift the money demand curve left or right, right? The three factors. You guys remember? We talked about price level, income, expected inflation.
Yeah.
So Friedman says that when the Fed increases the money supply, the money supply curve will shift to the right, but the money demand curve will also shift to the right. Why? Because, according to Friedman, the increase in money supply is going to lead to, one, price level is going to go up, which we talked about. Expected inflation is going to, the market is going to expecting inflation to go up because money brings inflation. You guys know that when you print and dump money in the economy, the market was going to expect inflation to go up. And then in the short run, money can have an impact on income is going to rise because you're dumping money. People have a little bit of higher income because of that, the income effect. So Keynes argued that all these three factors should be held constant. Friedman is saying, and that's the reason why the Keynesian model does not predict the way we're seeing it, because it's holding all these factors constant. We should never hold these factors constant. Okay, so that means according to Friedman, so now this is what Friedman is going to say. There are three cases though, under Friedman. So under Friedman, okay, an increase in money supply. Let's talk about it. Case one, because Friedman is saying that when you increase the money supply, both the demand for money and the supply for money is going to shift to the what? To the right. So we're going to look at case one. Friedman is going to argue that, and this Keynes should have looked at all this. Case one, we're going to say that money demand shifts more than money supply. Because when you increase the money supply, money has got an income effect, a price level effect, expected inflation effect, which shift the money demand curve. This is going to be money. Okay. So if this is the initial money supply and initial money demand curve before the Fed printed money, this was your initial interest rate. And then this is your initial level of what? Okay. So according to Friedman, this case, when the Fed print money, the money supply shifts to the what? To the right. But the shift of the money demand will also shift to the right, but by a larger proportion. See this? So the new equilibrium is where the two green lines intersect, which is this point. So that should lead to an increase in interest rate, which is what we should expecting, what we normally see in the data. When the Fed is printing money, typically leads to higher interest rates. Do you get it now, guys? Peyton, do you get it?
Yeah, that makes sense. Sorry, I'm messing with my dogs.
Okay. The reason why Keynes was getting as other prediction, Keynes held other factors constant. Keynes does not shift the money demand curve because he argued that when you print money, you hold all other factors constant. Now, the other factors constant are things like price level effect, inflation effect of printing money, income level effect, which should shift the money demand curve. But if you're holding them constant, according to Keynes, means the demand curve for money will never shift. You would only be shifting the supply curve for money. So according to Keynes, the interest rate would be here, according to Keynes. because it never shifts the money demand curve. So this is case one. There's what we call impulse response, which is associated with this case. The idea is that when you think about it, when we teach you classes in economics, we say you shift a curve, you see some value of something changing. You guys think it's magic, but it takes time. So if you simulate this model in order, that's what we call the impulse response of how interest rate is going to behave over time. So the impulse response is like, for case one that I drew, we want to see how interest rate behave over what? Through time. So initially, interest rate was I1, level of interest rate. If you look at this diagram, it was I1. Then according to this impulse, at some time, say T0, the Fed prints money. Okay? When they print money, there are two effects going on here. There's the liquidity effect, which leads to an increase in the money supply. Liquidity effect tends to pull interest rate down. So according to the impulse, at the time when the Fed started printing money, according to this impulse analysis, response analysis, the interest rate is going to try to go down because of the liquidity effect. But because we're saying that the money demand is greater than the liquidity effect, when the money demand curve shifts to the right, it pulls interest rate up. And if it's stronger, like we have seen in case one, interest rate is going to settle at a much higher level. And when we simulate this model in a computer, it tells you exactly how many quarters or month of the year will interest rate going to behave like this and settle at a much higher level, I2. So we call this an impulse. So we call this an impulse response. Then case two, I'm going to draw both impulse and whatever side by side. Are you guys going to go to class at 11:40, or do you have like 20 more minutes?
Unfortunately, I have another class.
Oh, you have another class. So when you have another class, you can just go, because I need to complete this. When it hits 11:40, you can go to another class. But I'm going to continue until 12, so that I have, because there's going to be like 1 or 2 slides remaining, so that when you can watch the video, because I'm going to upload this video anyway. That make sense?
Yeah, that's good.
Yeah. Okay, so let's talk about that. So case two is a case where Friedman is going to say that money supply is going to shift more than money demand. So when we say that, so this particularly means that Friedman is going to, this means the liquidity effect. I forgot to mention this in the first case. The liquidity effect is more than the other three effects. Because the other three effects are the price level effect, expected inflation effect, and income effect, which shift the money demand curve to the right. The liquidity effect shifts the money supply curve to the right. So in the other first case, I should have written here and saying, when you say money demand shifts more than money supply, this means the other three effects are more than the liquidity effect. Because the liquidity effect will shift the money supply curve. Okay. So here I'm going to draw both two graphs. I don't have to draw impulse differently. I'm going to draw two graphs side by side. Then draw how the impulse look like. I should have done that for case one. You can do that. So according to Friedman, in this case, there are times sometimes when the Fed prints money, we can see a decrease in interest rate, which he kind of agrees with Keynes here. So, but let me draw and explain it. So under this case, okay, the money demand curve is going to shift less than the money supply curve. So the money demand curve shifts to the right, like MD2, and the money supply curve shifts a lot. The magnitude to shift the money supply curve is bigger than the magnitude to shift the money supply curve. So the magnitude to shift the money supply curve is greater than the magnitude to shift the money demand curve. So here, the new equilibrium is where the two green lines intersect. See? So the interest rate is going to fall a little bit in this case. But the fall in the interest rate in this case is not going to be as predicted by the Keynesian model. The Keynesian model would have predicted it to fall up to this point. When you shift the money supply curve to the right, it would, for the Keynes, it would have fallen up to this level. But in this case, so in terms of the impulse, we want to see how interest rate behave through time. So we're going to have what? So we're saying before we have like I1, and then at some time, T0, the Fed decides to what? Increase the money supply. So under this case, the liquidity effect is more than the what? The other three effect, which pulls interest rates down. Other effect going to pull it back, but it's not going to go back to the original level. So interest rate ends up settling at a much lower level here. And then case 3 is a case where the liquidity effect and the other three effect completely offset each other. That's case 3. Liquidity exactly offsets the other three effects. So that's going to be something like this. And then we also draw an impulse response on the side to see how interest rate behave over time. So if we say the liquidity, when the Fed prints money and the liquidity effect is exactly being offset by the other three effects, it means the shift of the money demand curve to the right is identical to in size of the magnitude. It's going to be the same as the shift of the money supply curve. So let's so the money supply curve is going to shift to the right like that, M2, and the money demand curve is also going to shift to the right by the same magnitude. So the magnitude of the shift is the same. So under this case, if you draw it nicely, my drawing is not like chicken feed here, but if you draw it nicely, you can see in this case, there's going to be no change in interest rate. And in terms of the impulse response, you want to trace out this behave over time. That means this was I1, then at some time T0, the Fed increased the money supply. When they did that, liquidity effect pulls interest rate down, but the other three effects are going to exactly offset that. So that there's no change in interest rate. So, and if you simulate this model in a computer using the data, it tells you exactly how many quarters or months in the future, when you change policy, how interest rate is going to behave and settle at that level. And then the last case, according to Friedman, is a case where inflationary expectation is so super strong. Case 4 is inflation expectation is so strong and the market overreacts, and the market overreacts to what the Fed is doing. So in this case, you don't even see the liquidity effects. We don't have to draw the fast graph. You just draw, that immediately, look, we're just going to draw the impulse through time, because you never see the liquidity effects. So we're going to say this was I1, and then at some time T0, the Fed increases the what? Increases the money supply, because people are reacting that, oh, inflation is going to kill us. The market overreacts. You don't even see the liquidity effect. So interest rate just rise gradually like that. You don't see anything dragging interest rate down. Okay. And then a few other things. So I talked about this already. Okay. So these are the impulse response that I was talking about, how they look like. I only put 3 cases here. Okay, so inflation expectation is when the liquidity effect is, is more than the other 3 effects. This is a case where the other 3 effects outweigh, because, at time T0, this thing goes down, then it goes back up. Just additional trends. Okay. Daniel, do you see that?
Yes, sir.
Okay. So now there's some question that I wrote on the homework assignment where I give you the bond supply and bond demand in terms of equation. It's actually very easy to solve. Okay. I'll try to do the solution to that problem and post it at Canvas sometimes this evening. Because both of these assignments, I think, are due tomorrow. Quiz 2 is due tomorrow. Homework 2, I think, is due today or tomorrow. I think both of them are tomorrow. I have to check at Canvas. Make sure you do those. Watch the videos that you have not watched to be able to do the assignment to be ready for the exam. Because all the videos, I'm posting them at Canvas. This one, I'm going to upload it because it takes a while before it can process. And then I can put it at Canvas in the evening, by evening time, okay? Hello?
I'm sorry, what was it?
I say chapter 5 has got 2 parts. I recorded the first small when I introduced it, then the bigger chunk of chapter 5 is what we just covered now. So make sure you're gonna watch 2 videos for chapter 5. The one I posted yesterday or 2 days ago, I think. And then the one that the video that I just recorded right now. Then you're gonna be caught. This is on the only material that you need for exam 1 next week. Chapters 1 through 5 and chapter 19.
Gotcha. Okay. I was also gonna ask. That's why I stayed so late, because I also replied back to your email. I don't know if you saw, but I won't be back until Wednesday night. So Thursday would be the earliest I'd be able to take it, if that's possible.
Yeah, that's fine. Oh, you're the one who wanted to take the test at a later date. Yeah, that's fine. So you actually had a much advantage point. But remember, when you travel next week, I'm gonna be assigning assignments for. Make sure you're watching the video from wherever you will be.
Right. I'll still be attending these online Zoom classes, but I just won't be here in Texas. I mean, I'll be here in Texas, but I'll be in El Paso.
Okay, that's fine. That's fine. So when you come back, just let me know. Send me an email again because I may forget. I have a million things going on.
Right. Okay.
All right, we'll see you, man.
All right. Thank you. Bye.
Bye-bye.